Hello fellow traders. Today we get into understanding economic indicators and their impact on interest rates. These indicators provide valuable insights into the economy's performance and future trends. These are like those black swan events that happen in the markets. An understanding of them is essential for policymakers, investors, and anyone interested in economic health. Today we get into interpreting economic indicators by a pajama trader. Give this a like and subscribe. Let's get into it. Economic indicators are crucial for understanding market trends. Various reports influence interest rate decisions, including job reports, inflation data, and GDP growth. Accurate interpretation of these indicators are vital for policymakers and investors. Key economic indicators influencing interest rates. Jobs reports provide insights into the labor market conditions and economic growth. Inflation data, CPI, reflects changes in consumer prices and inflationary pressures. GDP growth measures the overall economic output and growth. Consumer confidence influences consumer spending habits and economic activity. Several economic indicators play crucial roles in shaping interest rate decisions. Job reports give us an insight into labor market health. Inflation data helps us manage price stability, and GDP growth reflects overall economic performance. And consumer confidence influences spending habits. How jobs reports influence interest rate decisions. Strong job reports can lead to higher interest rates and curb inflation. Weak jobs reports might prompt rate cuts to stimulate growth. And labor market data is a key factor in the Fed's dual mandate. Jobs reports are a crucial factor in interest rate decisions. A strong labor market can lead to higher interest rates to manage inflation, while weak market might result in rate cuts to boost the economic growth. Inflation data and interest rate decisions. Higher inflation typically leads to higher interest rates to control price increases. Lower inflation might prompt rate cuts to stimulate economic growth. The Fed targets an inflation rate of about 2% annually. Inflation data is another key driver of interest rate decisions. When inflation rises, interest rates often increase to manage price stability. Conversely, lower inflation can lead to rate cuts to boost the economic spending and activity. GDP growth and interest rate decision. Strong GDP growth can lead to higher interest rates to prevent overheating. Slowing GDP growth might prompt rate cuts to stimulate economic activity. GDP growth reflects the overall economic health and potential for inflation. And GDP growth is the broad indicator of economic health. Strong growth can lead to higher interest rates to prevent the economy from overheating, while slower growth might result in rate cuts to boost the activity. Consumer confidence in interest rate decisions. High consumer confidence can lead to increased spending and economic growth. Low consumer confidence might reduce spending and slow economic growth. Consumer confidence influences interest rates indirectly through its impact on economic activity. Consumer confidence plays a role in interest rate decisions by influencing economic activity. High confidence can boost spending and growth, potentially leading to higher interest rates, while lower confidence might result in slower growth and rate cuts. Why interest rates moves markets. Stock market impact. Higher interest rates can depress stock prices by increasing borrowing costs and reducing consumer spending. Lower rates can boost stock prices by encouraging spending and investment. Bond market impact. There's an inverse relationship between bond prices and interest rates. Higher rates decrease bond prices while lower rates increase them. Consumer spending. Interest rate changes affect consumer spending, with higher rates reducing spending on finance purchases like homes and cars. Interest rates has a profound impact on markets. In the stock market, high interest rates can lead to lower stock prices due to increased borrowing costs and reduced consumer spending. Conversely, lower rates can boost stock prices by encouraging spending and investment. In the bond market, higher rates decrease bond prices while lower rates increases them. Additionally, interest rates can influence consumer spending, with higher rates often leading to reduced spending on finance purchases. The power of economic indicators. Economic indicators are essential for understanding economic health and making great investment choices. Accurate interpretation is crucial for navigating economic trends and interest rate changes. Continuous monitoring and analysis are always necessary for staying ahead in today's dynamic economic environment. Let's consider the SPDR S&P 500 ETF as an example. Historically, the SPY has shown significant reactions to economic indicators, including jobs reports and inflation data. For instance, on November 1st, 2024, when payroll numbers exceeded expectations, the SPY experienced a notable reaction, reflecting the market's response to positive labor news. Similarly, changes in inflation rates can influence the SPY's performance by affecting interest rates and economic growth prospects. Economic indicators are vital tools for assessing economic performance and making informed decisions. By understanding and interpreting these indicators effectively, we can better navigate economic trends and interest rate changes. Continuous monitoring and analysis are key to staying ahead in today's economic environment. Thanks again for watching.